that in a minute. I'm gonna grab water.
I know.
Yes.
Correct. Yeah, it's like whenever you're doing it for the website.
Did David say he couldn't be here? Did David McDonald say he couldn't be here?
She's almost here.
Right, then he said it'd be okay. Okay.
Last weekend for Father's Day and Midnight.
We do. Just me and family.
Looks pretty big. Is it a puppy or?
Ha-ha.
That's the biggest smile I've ever seen on your face.
We'll see.
This is better than getting a raise, huh?
Yeah. No, not really. No.
It's way better in the middle.
Is it?
All kinds of different.
Over here.
Do you need a
There's one.
printed
Oh,
back? I
there
don't
you
have
go.
one. I have my computer.
That's why I stopped.
So, this is our first time hearing a board appointed thing, right?
Okay.
Paul is here. David McDonald is not here yet. So it's up to you guys how you want to conduct the interviews and stuff like that. And when you do a vote, there's no set way. So you can either do somebody make a motion in a second and do a vote, or you can have people write down what they want on a piece of paper and sign it and send it, and then I'll take a tally. So it's however you want to do it. And then I would announce it as well. Or you can have that as a discussion on the board. Or you guys can figure this out when you do it, whatever you say you want to do it.
Let's see without being.
Hey, John.
That is,
Okay.
it should be firefighter one.
Oh, for myself.
Yeah.
Sorry, let me just connect to the internet real quick. Oh, okay. Hello, everybody.
Hi.
You can take a breath now. Okay, everybody's here. We'll go ahead and call the firefighter pension board meeting to order. First item on the agenda is the citizens open forum. Do we have any citizens for an open forum? Seeing none. Next item is approval of minutes from the meeting March 23rd.
Move to approve.
Okay. Any discussion? All in favor, say aye.
Aye.
Aye. Any opposed? Okay. Second item on the agenda is presentation of the volunteer appreciation gifts.
That's you, Mayor.
Eric Seidel, 114 Shore Drive Place, Oldsmar, Florida. Hello,
Hello,
how are you?
Mr. Mayor.
doing well, how about you?
I'm good. We have a couple of things we want to do here this afternoon. One, we want to recognize a few people who've hit certain anniversaries with service to the board. It's funny because I was looking at the date on Renee's, and I'm thinking, wow, that was back when I was on this board. I think the very first board meeting I went to, do you remember what we were voting on?
No, I was so new, I don't think.
Mike Kelser, whether or not he was going to get his disability. Pedro remembers that, I'm sure. That's right. That was my very first meeting. Welcome to the board. Yeah, it was really good. I don't think Bruce has still forgiven me for that. I don't know. That's a long story. Anyhow,
Induction
listen.
by fire.
Yeah, that's the way to do it.
And I think there's only 3 of us, yeah. that
That's
day.
right. That's right. We were in here, I think. Yeah, it was good. So, as you all know, every year we try to have a volunteer dinner where it's our opportunity to say thank you to the volunteers. And of course, because of COVID, we were unable to do so. So we have been trying to do things a little different. And instead of having the big event, we're bringing a miniature event to you. So we have some refreshments here. And I should thank the clerk's office, because both Ann and Kathy have worked real hard to try to make sure we did this with every board. So we've been like the thank you volunteer traveling roadshow. So we get to be here with you all today. And it really is an honor for us to just be able to say thank you. We have these gifts. So anybody know what this is?
Oh, jeez.
See, I call it a cheese board because I'm pretty simple. And what's the actual name, Ann?
Cheese board.
Thank you. So we wanted to give you, see, this works so well. You know, look, I'll just say this real quick, and I'm going to keep it brief because I know you have a meeting to do. But it takes three things to have a good city, to have a great city. I really believe that. Number one, you have to have a great staff. You can't have a great city without a great staff, and we've got that. You got to have a good elected group of officials. And while we might be a little sketchy sometimes, I think we have a good team of people who care about the city and work real hard. But the third thing that you have to go from a city to a real community is you have to have quality volunteers. And without that, there's just so many things that would not happen in this city, that could not happen. We have almost as many volunteers as we do full-time employees who volunteer on a regular basis. We actually have a waiting list for most of all of our committees now. And that's not something that every city can brag about. I could tell you, in talking with some of my peers, they have a fit sometimes trying to keep their boards full. And so we not only are able to do that, but we do so with quality people. And so when we say thank you as a city council, we mean it because it makes a difference. So give yourselves a round of applause, please. Now that you all have your cheese boards, so I go throwing around the awards. All right, when I call your name, if you'd come up here, then I can hand this to you and do a photo op. Great. All right, so John, come on up. 5 years of service. Thank you. Round of applause, y'all.
Has it really been?
I was thinking too.
Holy cow, Batman.
Kenny, 5 years of service. Come on up. Round of applause.
Go, Kenny, go.
Wakes up high, right? There you go. Thank you. Thank you.
And last but,
I don't want to hear this.
and last but certainly not least,
30 years.
20 years. That's a long time of service for anybody. And I know we keep you as busy as could be anyhow. But you're still here, and we greatly appreciate it. And the plaque gets even bigger as you stick around longer. So Renee, come on down, please. Thank you.
That's great, Kevin.
Thank you. All right, once again, thank you for all your service. I won't keep up too long so your meeting doesn't go on and on forever, because that's always so troubling, and these financials and stuff you're going to go over are really exciting anyhow. So with that, have a great meeting. Thank you all.
Thank you.
Thank you. just want to take a second real quick to echo his sentiment that the volunteers that serve with us are very important, and we do appreciate your service. Thank you.
Thank you.
Thank you.
Thank
And when I started 20 years ago, it was kind of the, hey, wouldn't it be really cool if you, because I was still new. Okay, sure.
Bye, y'all.
Thank you.
Bye, thank you.
Next item is interview applicants for the board appointed trustee vacancy.
So, Madam Chair, we have two applicants, Paul Saraki and David McDonald, and Mr. McDonald is not here today.
Okay. So Paula, would you like to come up?
Hello,
How are you?
good.
Thanks for being here. So this is just kind of a meet and greet in case the board has any questions.
Okay.
Maybe you want to start with telling us a little about yourself?
Sure. Paula Saraki, 1743 Split Fork Drive in Oldsmar. I've lived here since 1995, and I'm very involved in a lot of organizations around the city, and I've been a small business owner here since 1999.
Thank you. And what drove you to apply for our board? Anything in particular?
Well, I really like to be involved in the community, and I like to expand my knowledge and try new things and always learn. So I thought this would be a nice learning experience for me, and I would love to serve on this board.
Okay. Does anybody have any questions for Paula?
No, but I would like to say, she has done, I was the past governor, or am the past governor of the Moose Lodge, and Paula's been very helpful in getting our newsletter put together. She does a real professional job, and I personally like to take this time to thank her because I don't think I ever got to do that when I was the governor. So thank you, Paula.
Well, thank you, John. Appreciate that.
Okay. Any other questions? Okay. So this is the first time we've done a board-appointed applicant, is that correct, Ann?
And for a very, very long time.
A very
I
long
mean,
time.
Carmine was on board before I even became city clerk.
That's true, that was a long time. So I think what we will do is we'll go ahead and we can do a quick vote ourselves. We can just write who we're voting for on a piece of paper, we'll hand them to Ann, and then she can read the results for us. Thank you, Paula.
Okay, thank you.
Oh, go ahead.
Pedro, this is Jeremy.
Yes,
Hey, can they do a vote without it being public?
so that was gonna be my comment as well. So I'm fine if you want to write them down on a piece of paper and then, Ann can read out the votes. But I do think just for purposes of the record, it should reflect who's voting and what they're voting for, if that makes sense. So however you guys want to do it is fine. I don't have a problem if you write the name down and then Ann reads it. Just so long as it's, when it's read, it's Chairperson Renee voted X, right? Or something to that effect.
Alternatively, you could have somebody make a motion, somebody do a second.
Or correct, or we could start with having a motion made and with a nomination and a second to the nomination.
Okay. We can just do the nomination. I think that's probably easier.
Okay, I'll make a motion to nominate Paula for trustee.
I second it.
Okay, any other discussion, questions? All in favor, say aye.
Aye.
Aye. Any opposed? Welcome aboard.
Wow, thank you very much.
So, Paula, we'll
Thank
send
you very much.
We'll send you a letter. If you can come to the July 20th meeting for
Okay.
city council, then we'll just ratifies or makes it formal. I think we need to do that, right, Pedro?
Correct. So it should be placed on a subsequent city council agenda. And so this council will, as a ministerial function, so in other words, I hate to say rubber stamp, but they would formally approve the board's election. And then, we would have our fifth trustee officially seated at the subsequent meeting, whenever that takes place.
Very good. Well, thank you very much. I look forward to serving with you. Am I free to go, or should I? stay for the meeting?
I think you're free to go if you'd like, or if you'd like to
It's-
stay, you can.
Yeah, it's up to you. I did want to remind you though, and I'm sure you'll get reminded at some point, but whenever it is that the council finally appoints you, there is a financial disclosure form that you would be required to file. So we can talk more about that, whenever that happens, but that is something that from your appointment, you would have 30 days to get that on file. So I just want to make sure that you're aware of it.
Okay, yep, not a problem.
Okay?
Yep,
Yeah.
thank you. Thanks, everyone.
Thank you, Paula.
Okay, next item is presentation of the quarterly plan investment report.
So everything in here, if you want to follow along, as of, you can see as of March 31st, your beginning balance was just over $8.5 million. There were $64,000 in contributions that came in. We saw earnings increase of just over $304,000. Paid out $14,500 distributions at about $11,000 in expenses. Your ending balance was $8,876,851.90. I think your next page or two is just the accounting of the ins and outs of cash flows. Any questions about the dollar amounts before we go into the investments?
I do have one, and it's a stupid question, so you should be expecting them at this point from me. Under earnings, how come it doesn't say like unrealized gains or gains, and it says earnings? That's always nagged me. You know what I mean? It's not an earning because the portfolio goes up. Or is that our dividends that are coming in? That's just the growth of the portfolio.
That is the value that the actual dollar amounts you receive in earnings over the quarter. Yeah, so that's not it's, unless you want to split hairs, which we can certainly do. I mean, it's realized minus the fact that you're keeping it invested. I don't feel like I answered your question yet.
No, well, I mean, is it unrealized or realized, and are there dividends in it? But it's neither here nor there. I've been doing it for a few years with it. I was just curious.
I guess, I apologize. I don't think I'm doing a good job of following you. It's realizing the fact that that's how much money now there is in the assets, which is being invested and continue to grow. It's not realized in the sense, obviously, you didn't take that money. As far as dividends, you're talking about from certain stock holdings?
Just, yeah, the overall portfolio. It's earnings is a misnomer to me. That's all I'm saying.
Okay. Yeah, I don't, the only dividend part would be, for the most part, I don't think you have too much exposure to any dividend stocks, but those typically a lot of times will end up coming in. So I couldn't say whether or not it's reflecting any extra potential dividend.
You're good.
Any other questions that hopefully I can do a little better job on?
Sorry.
Okay. As far as the investments for the quarter, probably about the 13th page down. It was another very good quarter, up 3.56% for the quarter. Of course, that comes on the heels of almost 12% the prior quarter. So as of March 31st, you were sitting up 14.76 for the 2 quarters of your fiscal year. We've probably added a little bit more, I'd say, as well. This quarter, obviously, we're coming up at the end of June now, so we're about to finish the quarter we're currently in. So I think it's going to be a little bit higher. I don't know if we're going to quite see the returns that we've seen prior to, but still moving positively forward in market. It's kind of interesting to note too, this as of being March 31st, essentially we've seen the value of the COVID impact at the end of last March to now we're basically looking at peaks. I think we've even ticked up a little higher, but you're close to the peaks here. So you can see the 1-year number of 37.5%, which is kind of amazing. And then and of course that's all being mostly driven by equities. then so you look down, a little farther, you can see the US large cap up almost 68%, small mid cap 64%. An incredible, kind of V-shaped recovery that we've seen last 12 months. So I don't think we would have ever thought we'd seen these numbers a year ago, but we are certainly very excited to see it. In addition to just good absolute returns, our managers themselves are performing very well also. But on that note, I do want a couple things changes we've made. One is within your Core Plus bonds. So you have two bond portfolios. Each of them have 50% of the fixed income. The Core Plus had two managers, Franklin Templeton and Pioneer, and each of them had 50% of the Core Plus funds. Franklin Templeton had been underperforming for a little while now. Additionally, their strategy, or the reason they were brought on is their strategy was meant to be a complement to Pioneer, so they weren't necessarily in competition with each other to see who's better, but they're supposed to complement each other. Moving forward with the way the market environment is and the way our consultant, our board thinks it will be moving forward, that complementary strategy they don't believe that's going to continue to exist. So you pair that with the fact that they're underperforming. They did decide to remove Franklin Templeton from the Core Plus. The good news is Pioneer has been performing extremely well for quite a while now. And so instead of needing to go off try to find a replacement, we've just moved the assets over to Pioneer. Of course, we've given them the charge to continue to outperform. So we're going to hold their feet to the fire as far as that goes. So that was one of the changes made. Any questions about that particular change? There's nothing, because essentially you all have adopted our investment policy and you're part of the trust. There's nothing you all have to do. Those changes just come. You don't have to take action, but again, make sure you all are aware if you have any questions. Hearing none, the other big change that was made in the quarter is more of a looking forward strategic change. So kind of ironic, we're sitting here, we're looking at 15% return for the quarter, almost 8.5% average returns over the last 10 years. So unprecedented returns. It's been an incredible market run. But then I get to follow all that great news up with and we've been talking about this for really a couple of years now, but the chatter is getting louder that there's a slowdown coming. Not necessarily, hopefully not a crash, hopefully not a big recession. But it seems more and more inevitable that we're going to hit a point where we're not going to see 8.5 returns year. And then over the next handful of years, we'll see multi-year returns with 5, 6% returns. Again, this is maybe 3 to 7 year outlook. But so a considerable amount of time. Again, in the long run, the 7% you're assuming, we believe that would still be appropriate. So we're not necessarily thinking you all need to make any big changes at this time. So again, more informational things. But strategically, because we do think this is going to be more than just, whenever this slowdown does hit, we don't think it's just going to be a little bit longer than that. So we want to position ourselves accordingly. And what we've seen in this run-up is the U.S. large cap has been the biggest driver. But as a result of that, it now has kind of the least amount of opportunities, we believe, over the short period of time. You look at the S&P 500, that's your largest 500 U.S. companies. Really, it's just a handful of companies within there that have been driving the market for quite a while. But what's happened is, if you want to go buy a stock today in that group, you're going to overpay from a historic standpoint. Value is just not there. You have to pay a lot. An example of that, or kind of the way that, to put it in easier terms, again, the S&P 500 historically has traded 10 to 15 times earnings, so that would be your stock price. I think it's probably up around 45. In other words, again, you're going to really overpay for a lot of the companies within that space. So that being said, we don't think necessarily there's going to be as much opportunity for growth over the next little period of time. So what we're doing is we're taking our target allocation, and it was 34% into the international. So it's going from, I think it's, 16 to 5, I believe. No, I'm sorry, it's 13 to 22. Somewhere right around there is, sorry, usually I have this in front of me. You all don't happen to have that page in this report, do you? I pulled up yours. Sorry, when the page is sitting in front of me, I can do it by memory, and as soon as it's not sitting in front of me, I just blank a little bit. So, let me do this. I think it went from, because it's 6%, we added 6% to the international, so I think it went from about 16 to 22. And then the other remaining 3% went into the small mid cap, and that went from 11 to 14%. So again, we're taking 9% out of the US large cap, putting 6 of that into international, 3% into the small mid cap. And again, we've seen great returns in both of those other areas too, but we haven't quite seen as much of a run up. So we think going forward, there's going to be a little more opportunity for growth. So again, we're not changing the total amount of equity exposure, just a little bit of different way to target it. Any questions about that change?
What was the small going to?
I believe it's 11 to 14. We're adding 3%. Any thoughts? I mean, anytime, because I know you always have some good input, and I always take everything to our board, and I'm happy to.
I just think it's very aggressive, but
Is
yeah.
it small mid-cap part or just any
Small,
other?
both, but yeah. A 9% move is a big move, but yeah.
It is a big move. And if I'm being totally honest, when it was presented from our consultant, this kind of gets your attention. And of course, they, on a much longer scale, time-consuming scale, they went through and explained in great detail. And I'm happy to get some more information if you all are interested into the reasoning and why they believe in. And one of the biggest things that they do is they do, now, of course, you have to take it all with a grain of salt because it's forward-looking, but they do a lot of modeling. And one of the things that was very surprising, but pleasantly surprising, is that, my biggest thought when I heard that was, well, not only is it potentially more aggressive, but you could be introducing a lot more volatility, because typically the small mid-cap and international markets have big swings, large cap market. And so they said through their modeling, again, because of the situation in front of us, meaning if the US large cap is close to maxed out, therefore there's more potential for bigger swings, and that when they modeled it out over the next kind of intermediate time frame, they actually did not see any increase in volatility, that if anything, this should help actually smooth out the portfolio in addition to hopefully. You're not talking about big differences where we're trying to chase an extra 1 or 1.5%. This is, we might only see 0.5% extra gain in going this way at the most. So a lot of it was actually, the argument was actually smoothing out some volatility as well. So when we are, and kind of to your point of aggression, that's always one of the biggest things that's taken into account with any change that they make is this a risk appropriate change?
And that's in the 60-40 portfolio.
Correct.
What are they doing in the 70-30?
Same change. There was a slightly different starting points with the allocations within those,
All right.
but the same equivalent change. So all the changes that are made, I can absolutely assure you that they go through the painstaking process of looking at to see what this will do to risk. They don't ever, if we're looking to get some more return, which we are in this case, we want to make sure we're not doing it by taking any extra. And additionally, one thing I am going to have for you on at the next meeting is, because it's probably been quite a while since you all even really got some information on who the consultant and investment advisory committee is that we have that works on this portfolio. I'm going to have some information for you all. We can kind of talk about that if you all have any questions. of see the brains behind what's happening. Good for you all. Carry it through, and then looking farther forward, but this is probably getting into next year at this point. It was actually something that was coming until COVID hit, kind of threw some wrench in it, but I'm gonna actually have the consultant, probably somewhere within this greater area, where we've got a handful of boards who can all kind of come get together one day and actually have a kind of a presentation. By the end of it, you'll be able to do a give and take.
And again, I apologize if I can have one more second, Joe. I'm staring at the screen up here with the numbers, right? You're essentially telling me we're yanking 900,000 out of the diversified large cap, putting 600,000 into the international, which will put that over 2 million, and then another 300 into the small mid cap, correct? So the international is gonna be over 2 million, the small and diversified will be at 1.3 and change, and then the diversified large cap is gonna be down to 2.6, or no, 2.3.
That would be the really rough, quick math, but yes.
Okay.
What would be the concerns?
The enormous international exposure. And I'm not as worried about the small mid-cap one as I am the international. And they have not rebounded, they haven't come back, there's still a play for that, and I understand all that. I just think that's it's a big move, taking that major chunk out of the US. That's.
It is. Another important part for you all also to be aware of is we do have within our investment policy, we have a 10% leniency for target allocations. So we move it to 22%. If the market starts reacting in a way that was unplanned, we have the ability to be nimble still and make moves back without necessarily going through the full process of going to our boards and having formal meetings just to make the changes. So while again, these are target allocations, but we're not beholden to them if market conditions end up looking different than they're expecting.
But the next meeting, we'll see the comparison, like, we'll see the numbers changed.
Yes.
Okay.
And actually, I will, so interestingly enough, too, this is just kind of more FYI. On the international portfolio, there's actually a 25% limit by state statute that a pension plan can have investments in. So if at any point in time we bump up to 25%, we're going to automatically, now we would probably definitely count anyway, but by statute, we'll bring it back down. Again, that's not going to really impact you because again, if we got that, we would naturally do it anyway. But just kind of conditional. There is by statute.
And I apologize, if you want me to stop, just let me know.
You good?
These are good questions to
Yeah.
ask.
For the international equity, what's the exposure to the fund? And I know it's 1.4, it's not a lot here, but from a holistic standpoint of the whole portfolio, now you're literally talking 20% of the portfolio. When I'm looking at 8 million and you're telling me over 2 million's in there. Is this across the board, large cap, international equities? Is this global, or is there any US in that? Or is this all ex-US?
With the irony being, and I know you understand this, funny enough, there'll be major U.S. household name companies that have put their domicile, or from another country. Take that for what it's worth, but it's not necessarily always going to be just multinational, huge corporations buying into portfolios. They just happen to not be U.S. based.
Right.
But yes, there's no US companies. No, those are, I welcome any questions you have, and like I said, anything I can't answer, I'll get you the answer.
That's just a big move, that's a big move.
So this is the end of March, So have those changes already taken place then, you said, or?
They have, off the top of my head, I don't recall the exact date, but yes, these have.
So we might see something in the monthly statements that could show us what they're performing, or?
Don't think the monthly statement.
Actually, that's
Be
just
the
the
quar- it'd be the
expenses.
next
Yeah, it'd be the next
That's right.
quarterly. Yeah, your monthly statement, I don't think that you all get. I mean, we're getting constant reporting and conversations throughout the quarter on our end. I don't think the monthly statements that you all get, those are just accounting purposes. I don't think they show the breakout of each manager.
But we're almost to the end of the
Yeah.
next quarter anyway.
Yes, our quarter, so this report this report is actually compiled by the consultant. It's typically produced about 6 weeks after quarter end. The reason is for the most part, they're waiting around for all of the other reporting that has, so the managers get their information in pretty quick within this portfolio, but because there's a lot of comparison analysis with other peer groups, indexes, market conditions, blah, 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 it ends up being about 6 weeks before this. So it will have it available by the second week of August. I'll make a note, if you are, when Stephanie sends this out, when do you typically?
We turn it around pretty quick and
Okay.
send it out.
So, I mean, but Stephanie gets this to you well ahead of time, before the meeting, right? But you didn't just
Yeah.
get this report.
Yeah, usually we get it by the third week of the month following the end of the quarter.
Right, okay, yeah, so, and then you disseminate to them pretty quickly, okay, good. But if you all have any questions or you don't have it, especially by the third week, I mean, usually you should have. If you don't have it by the third week in August, please holler at me, I'll be happy to get it. I don't necessarily have any other prepared remarks, but happy to answer questions.
Sorry. It's okay. That's why we're happy to have you.
Well, and if it makes you feel better, there's plenty of boards out there that they'll ask, 30 minutes worth of questions and conversation. Please don't feel bad. It's a very light.
Well, it's hard.
order, actually.
It's hard because there's nothing we can do about it.
Theoretically correct. I mean, again, your voices do not go unheard. But as far as the board itself, you all could.
Any other questions, comments? Thank you. Okay, next item is approval of the administrative budget report for quarter end March 31st.
Madam Chair, we are presenting the quarterly the quarterly budget report for the administrative budget. While this report is not, while the adoption of the administrative budget is required by statute, the periodic reporting is provided as a courtesy to the board. We do not see anything unusual. The expenses that have been paid to date are expected. We have legal fees of about $5,000 year to date, as well as audit fees of $4,500, which were approved at the last meeting. Plan administration charges total $8,575. We are well within the 50% of the fiscal year, so everything appears to be on track.
Any comments or questions?
Are they opening up things for travel, for the trustee training and all that?
Yeah, Pedro can go over that when we get to the attorney update, but we can certainly discuss that, and the training is available.
Or if the
Yeah.
conferences are available?
I think the PPA, I think they have some, Pedro, I think probably knows a little bit more about them, but the state, unless they just did it extraordinarily recently, has not given us any.
So Pedro, if Jeremy brings in the market managers, can that be used as an educational session? You still there? We'll ask him when we do the attorney update.
He's mute.
Yeah.
Okay, I've stepped away. It's still on.
I can tell you just on that conversation, because that's a topic that a lot of boards and I've heard attorneys speak to this matter quite a bit, is how do we fulfill those requirements, and the state is very vague, so nothing goes on. So some boards take it upon themselves to require themselves essentially to go to X amount of training over X period of time, whether it's one training per term or whatever they come up with, and that's really kind of up to you all as a board to come up with your own policy for that. Other boards, which the state has never heard of, at this point in time, just uses the fact that they have an attorney and myself or another consultant at each meeting, providing information, updates, educational pieces, that manner. And so far that seems to also have satisfied the requirements. So he may want to expound, but I've yet to hear anybody ever actually say, here's the line in the sand you have to cross. It's been vague, and I've seen boards go on all ends of the spectrum with no issues I'm aware of yet.
Yeah, I do have some notes from our last meeting. The trustee school will be online. The state has canceled the in-person school. The FPPTA has lots of different online training options available. So it doesn't appear there's any, unless, Pedro can give us an update, any live in-person conferences.
Has everybody had access to the FPPTA website?
Kenny wants to run the meeting. Well, the reason I was asking, just because as I was poking, is that our upstanding new member would be a great opportunity to sit through that stuff for a couple days.
Oh, definitely. Okay, any other questions or comments on the presented budget? Thank you.
You skipped over item 5,
Did I? Oh, I did, didn't I?
which is yours.
Number 5, announce reappointment of the board appointed trustee Renee Neiman. So,
Little typo, you were
Congratulations.
reelected for firefighter position 1.
It was a hard-fought race, I heard.
yes, yes, it was very.
I do have a question, though. Theirs are 2 years and ours are 3, the terms?
No, yours are 2.
I thought we changed it.
No, you discussed
We
changing it.
discussed it, but I don't think we ever
wasn't
changed it.
anything you put through. And I think part of that was to change it, might have been to change ordinance or there was a lot more involved, so it just stayed.
Okay, then.
Okay, did I catch everything now? Number 8, accept interest rate assumption and actuarial evaluation report for October 1.
Okay, we have Chuck Carr from Southern Actuarial Service online, and he
I'm
is
here.
Oh, yay! He is going to discuss the interest rate assumption and the valuation report.
Yes. I don't know if you have it in front of you. If you don't, it's not particularly important. The valuation report I'm going over was prepared as of October 1, 2020. And I think we issued it maybe back in January. And so we're actually going over it probably a little bit later in the fiscal year than we normally would. Anyway, there were no plan changes, just for the record. No plan changes were reflected in this valuation report. But there is a change to the assumptions that I wanted to go over briefly. You may recall that a few years ago, Florida state law was changed to require all Florida public pension plans to use the same mortality that's been used by FRS. So we pretty much just have to follow along with whatever they decide to do. I believe it was effective for their July 1, 2020 actuarial valuation. They have updated their mortality tables or changed their mortality tables. They've changed to something called PUB, P-U-B 2010, and the PUB does stand for public. To my knowledge, this is the first time we've had public mortality tables that were developed based on public sector employee experience as opposed to the general population. So I probably would have recommended that we go to these tables anyway, even if FRS had not done so, and even if we weren't required to follow suit. There are over 100 tables that are in this family of mortality tables that we call PUB 2010. FRS, what I've done here is I've used the very specific tables and the combination of tables that FRS has used. So I have mimicked exactly what FRS is doing for purposes of this valuation. There are three broad groups of tables within the PUB 2010 family. There are public safety employee tables, there are general employee tables, and there are teacher tables. So again, I have used I've used those tables in exactly the same way that FRS has used them. Now, this was an update in the sense that these tables were just published about 2 years ago, 2.5 years ago. So they are kind of the latest, greatest mortality tables that we have available to us. That being said, you would think that changing or updating the mortality would add to the liabilities of the plan and would increase the cost of the plan. In fact, the opposite is true. What happened is both of the old table, which was the RP 2000 table, and the new one, with both of those tables, we are applying a mortality improvement scale. So that basically within the valuation itself, we are making an assumption about how much life expectancy will improve over the next 50, 60, 70 years, basically as long as our youngest participant would be expected to be alive. So we've got this long-term improvement in life expectancy that is built in the valuation. What happened is that with the old projection scale and the old mortality table, FRS was, and we were also by default, we were over projecting improvements in life expectancy. So the reality is life expectancy hasn't improved, at least in the last few years. It hasn't improved as much as we expected it to. And that's actually where the cost savings is coming from. So they, and they also, FRS did, the way that they used the tables for public safety employees, and I've done this here, this is another factor that plays into the cost savings. They've actually pretended that male participants are 1 year older than they really are, which means that you actually have a little bit, obviously, shorter life expectancy. So if a participant is currently age 50, we're pretending that person is age 51. Again, that's what FRS is doing. I've mimicked exactly what they're doing here, but that's another reason that we had a net cost savings from this change. You'll see what the savings is in just a minute. Other than that, all the other assumptions are the same from last year, including the 7% assumed investment return. We do get that return every year, usually later in the summer. We get from the FMPTF investment consultants, they give us a kind of a projection of what the long-term expectation is related to the returns on the portfolio. They give us that for both the 50-50, the 60-40, and the 70-30 portfolio, separately. They don't give us a single number. What they do is give us a chart that shows the likelihood of achieving certain returns on a long-term basis. And then we kind of go middle of the road. And 7% is what they have projected as kind of the middle of the road, mainstream long-term expectation for that 60-40 portfolio. We've been at that for several years. I suspect at some point it probably will drop a little bit. Maybe this year, I don't know. I'll have to see what they provide to us. But this is not, by the way, we're not trying to predict, what the return will be in the next 1 or 2 or even 5 or 10 years. This really is a long-term assumption. So if we were trying to predict returns in the very near future, it could well be that we were would be using something a lot less than 7%, depending on what the perspective is. So anyway, that's our interest or discount rate. And as I said before, we've been at that rate for a number of years. I'm not going to spend much time going over the assets that are shown in the valuation because these numbers are very out of date, and Jeremy just gave you much more updated numbers. But just for the record, as of October 1, 2020, our market value of assets was a little over $6.9 million. On an actuarial value basis, I'm actually using $6.85 million. The reason that I'm using something a little bit less is we do have an $82,000 advance contribution from the city. This is where the city, as of October 1st, 2020, had made deposits, contribution deposits into the pension fund that were in excess of the minimum required contribution. And so what we typically do, unless we're instructed to do otherwise, is we will take any excess contributions that are made, we will sort of put those aside, and it basically becomes a credit that the city has with the plan, such that the city could choose to reduce the current year's contribution, just as an example, by $82,000, in which case I would look to this $82,000 contribution credit to cover that shortfall between the actual contributions and the minimum required. The reason this happens is usually because the contribution rate that we develop, for example, the rate that's developed in this report applies to the current fiscal year. Obviously, we don't have these reports until a few months into the fiscal year. And so sometimes the city may already have budgeted for or may already have been contributing at a higher rate for part of the year. And that can be just one way that you can end up with the advanced contribution. Most cities do carry some amount of advanced contribution with the pension funds. It's good, it's handy to have that, from a budgeting standpoint, because if we have a year when the contribution rate goes up, for example, and maybe it goes up by an amount that the city just has not budgeted for or can't handle for that year in the budget, the city could then use this advanced contribution credit to help cover any gaps that haven't been budgeted for. So I think it's a good thing, a helpful thing. The money is actually a part of the trust fund. I just can't recognize it as an asset of the plan until we recognize those contributions or apply those contributions to the minimum. So again, the actuarial value that I'm working with as of 10/1/20 was $6.85 million. The overall return that we calculated for the market value was just under 6%. This was for last fiscal year. Of course, our assumed return was 7%, so we did fall short by a little over 1%. That being said, for the last 10 years, we do have a chart that shows the 10-year average of returns, and the 10-year average return is a little over 7.5%. And during that period, we were assuming an average of 7.35. So we have beat, for the last 10 years at least, we have beat our assumed return by about 15 to 20 basis points, which is good. So let's go to the bottom line, which is on table 1A, the first page of table 1A. I'll give you a second to scroll up to it. We're almost there. One more page and we'll be there. One more back. There we go. Okay, so this shows you in the box at the bottom of that page the required contribution rate for the current fiscal year. It is 38.4%, and that is about 4%, roughly 4% of pay less than the required contribution for last fiscal year. As mentioned before, the drop is due primarily to that assumption change. If we go over about 3 pages to table 1C, this is a table that's called gain and loss analysis, right there. This doesn't show you the contribution rate, but actually something called the normal cost rate, which is most of the contribution rate is made up of the normal cost rate. There is a slight adjustment for interest. That's why it's a little bit different, but this will at least give you a feel for how things changed or why they changed. So we added almost 1.5% of pay to the normal cost rate due to the investment loss. That was, again, that 1% investment shortfall for last year. But then that was more than offset by over 5.5% of pay decline due to this new mortality. So it was pretty dramatic. What I found is that the younger the group on average that I'm working with, the bigger impact or the bigger reduction that change in mortality had. If I have an older group that maybe I have a plan that's just retirees or mostly retirees, the impact of that change was not nearly as dramatic. The reason for that, again, is when I'm dealing with a younger group of participants, there's a lot more years that we're projecting the life expectancy improvements. So if we pull back from that, it has that pulling back on the life expectancy improvement over the next few decades has a much more dramatic impact for a younger group than for an older group. That's why for years, so to be over a 5% of pay reduction in the contribution rate due to that is, you guys are, one of the younger groups I deal with, but this is also one of the more dramatic impacts that I've seen. The demographic experience, which is just 0.06% of payroll, that's just a little tweak. That's really just a balancing item. It's just all of the experience related to the demographics of the plan, everything from pay increases to retirements, more or less than we assumed, and so forth, employment terminations, all that stuff combined. Basically, we were break even. So the real reduction, as I said before, was due to that mortality assumption change. So the contribution rate for the current fiscal year is 38.4%. That's the employer's rate. That does exclude the 5% employee contribution. If we go back about 2 pages to the page that shows those pie charts right there, you can see the breakout. Now, last year's breakout is the real deal because I have the actual numbers. So last year, the actual city contribution worked out to be just over 33% of payroll of pensionable earnings. The chapter money was about 9.64% of payroll, and of course, employees contributed 5%. If you look at the middle chart, the one that's a little darker in color, these are estimates. They're just estimates for the current year because obviously I don't know at this point what the real pensionable earnings will be, and I don't know what the actual chapter money will be. But on an estimated basis, we're expecting the city contribution to be just over 28% of pensionable earnings for the current year, and then for the chapter money to equate to about 10.34% of pensionable earnings. And again, the employees would contribute 5%. The last thing I wanted to point out is just something that I think most trustees find of interest, and that is over on table 1-E, which is page Roman number 1-6. At the very bottom of that page, you'll see right at the bottom of that page right there, there we go. You'll see the funded percentages for the plan. We are well over 125%. We're actually 129% plus as of 10/1/20. That means theoretically, if we had shut the plan down as of October 1, 2020, and just said, let's just settle up with all the participants, we'll give them a lump sum that's the actuarial value of whatever benefit they've earned to date. We'll just sort of pay everybody off whatever we owe them at that point in time. We would expect to have over 29 cents left over for every dollar we paid out of the trust on that basis. So that's very good. This is certainly one of the higher funded percentages that of clients that I work with. And it's obviously a very positive factor to have such a high funded percentage. This usually begs the question, if we're over 100% funded, why do we even have a contribution requirement? And that's a very logical question to ask. The answer is because the Florida state law does not allow us just to fund benefits as they accrue or as they're earned. So while we are over 100% funded on an accrued benefit basis, we are not 100% funded yet on a projected benefit basis. And that's where the contribution requirement comes from. We have to keep putting money into the plan to pre-fund, if you will, future expected benefit accruals. And that's where the contribution comes from. Nevertheless, it's really good to be, at this funded percentage. It's a very healthy thing. The fund is very healthy. We obviously can withstand. I mean, I know the asset performance has been very good of late, but if there is a correction in the markets or whatever, we should easily be able to withstand that and not wreak too much havoc with the city's finances as well. So that's pretty much everything I wanted to go over related to the valuation report. Does anyone have any questions or anything that I can address of an actuarial nature?
Any questions for Chuck?
My only one is, can you tell me what the hard dollars expectation are from the city this year? The city
Yes.
contributions?
Yes. So and this again, of course, is just an estimate. is just under 250,000 total. Let me quickly see what the chapter money came in at, because of course I have no idea where the chapter money was. So the chapter money was 67,000 last year. If we get about 65 or 70,000, then we'd be looking at about 180 to 185,000 from the city.
And that doesn't
And just
include the
for
credit?
comparison, so that lines up with last year, the city deposited 183. So the dollars I'm estimating are gonna line up pretty much roughly for this year. The dollar funding requirements from the city itself should line up roughly with where it was last year.
Did that answer your question?
What is that, like 1% of the, or 0.5% of the city budget?
That I don't know.
Do that calculation real quick.
Yeah, we're at like 36 mil.
Yeah, that would be 0.5% if it's 3.6 million.
Have we had like major chunks before in the past, or has this been staying fairly steady for us?
If you look at table 2E, in the valuation report, there is a 10-year history. It only goes back 10 years, but it will, I think, somewhat address your question. There we go, right there. So the upper leftmost column shows the employer, and this is excludes the chapter. There's a separate column for the chapter contribution. So the city alone, 10 years ago, it was just under 300,000, 294, then 201, 229, then it dropped. We had a few years where it actually dropped to 0. And then we've come back from that. The last 3 years, we were at, for FY18, we were at under 150, then 176, last year 183, and as I said, this year, I'm estimating will be between about 180, 185, depending on where the chapter money falls.
Okay. Thank you.
Yes, sir. Okay, well, there is no requirement that you do this today, but if you are happy as a board with the actual evaluation, at some point it would need to be formally accepted. It's only at that point that it becomes, the legal document or the bill or invoice, if you will, to the city as far as the contributions for this year. Also, once the actual evaluation has been accepted, we have 60 days under state law to get it filed with the state. We do that filing electronically, and typically, assuming you approve it at today's meeting, I will send a text or email to Lisa back in my office to let her know that it's been approved, and then within a day or so, she will most likely get it filed with the state. We take care of that filing for you, so there's nothing for you guys to worry about related to that. The other thing that, the other kind of bit of housekeeping that would need to be done is, and I'll let Pedro, he can say it a lot better than I can, but there is a requirement that the board each year approve the expected investment return for the, help me out, Pedro, for the next year, the short term and the long term thereafter, or something to that effect.
That's exactly right. It tricks me up every time, but Jeremy actually knows it exceptionally well. But I think that's right. That's close enough.
Okay, so typically the board would approve the 7% that we're assuming. If that's not the case, if the board were to approve something different, I suspect it would probably raise some eyebrows at the state level with Division of Retirement, because then they would say, well, if you're expecting something different for the long term, why is your actuary using 7%? So typically, assuming you agree with the 7, that would be what you would adopt for that purpose. But obviously, there's no requirement that you adopt the 7. Just if you think it should be something other than 7, we should probably revisit the valuation and what we're assuming there for the investment return.
Does anybody have any other questions for Chuck?
So I think that's exactly right. I was gonna suggest, if the board is comfortable, I think the first motion would be to approve the valuation report as presented as of October 1, 2020, and then After that, then you can go on to this, which would be actuary's recommendation and our consultant's recommendation that the same percentage be used and filed with the state as our expected rate of return for this year, next year, and the long term thereafter, I think it is.
Okay.
Sorry,
Expect the rate of return for the next year, the next several years.
Thank you.
okay.
But he said, as he was saying, if you could hear, you want two different motions.
Motions, yeah. So if there's no further questions, just need a motion to approve the valuation report as presented.
Make a motion.
Second. Any other questions, discussion?
Second.
Okay. All in favor?
Aye.
Any opposed? Okay. Valuation report accepted. Next would be a motion to approve the interest rate assumption as presented for this year, the next year, and several years. Make a motion?
I'll make the motion.
All
I
right.
second.
Any other discussion? All in favor? Aye. Any opposed?
Over here.
You opposed?
Yeah, I just, with my licenses and fiduciary responsibilities, that's an aggressive 7. So I'm just gonna do my 1 to 3.
Okay. We can discuss next time it comes up.
Yeah.
Okay, well, thank you, guys. As I said, I'll send Lisa a message to go ahead and get the actual report filed with the state. And just let me know if you have any questions. I'm gonna leave the meeting, but Jeremy, as you know, you've got my cell, so if something comes up and you guys need me, just shoot me a text or something. I can always log back in.
Thank you, Chuck.
Thank you, Chuck.
Okay, thank you, guys.
Thank
Talk to you
you.
later. Bye.
So next item is approval for payment to the FMPTF invoice for the actual evaluation. I cannot talk today, I'm sorry. Approve payment for the actuarial evaluation report.
Move to approve payment for the actuarial valuation report. Say that 3 times.
I second.
Any discussion or questions? All in favor?
Aye.
Aye. Any opposed? Thank you.
This is the fun one. I enjoyed reading this.
The fiduciary.
Yeah, I was getting into the weeds and then I had to stop myself.
So the next item is accepting the fiduciary liability insurance proposal.
Okay,
And
Madam
payment of-
Chair, as we discussed at the last meeting, we reached out to at least four different companies. We have one no quote. We had limited success. We tried to get several different values for the insurance policy. The Florida League of Cities, or the FMIT, came back with an aggressive proposal for $1,893 per year for $1 million of coverage. Cincinnati Insurance Company came back at $2,608 for the same coverage. And then we had a third for $1.5 million of coverage that was an outlier at $6,500. So with that, we are looking to the board to make a decision on which proposal to go with.
There was one part I just wanted to point out to you guys. Can you flip down a page or two? There was a, stop there. All right, that one had the 0 deductible, and that was the first one, correct?
Correct.
Yeah, the other one had 2,500 or something. Yeah. Yeah, that was it. The only other, where it says policy level shared annual aggregate limit applies, does that mean that we can use it several times? And I don't know. I mean, it's a $600 difference, but I just wanted to point out that little oddity in this one. Just for me, I guess talking out of turn as I'm asking questions, but we've been using the other one for how long? 10, 15 years?
At least.
Yeah. God willing, we'll never have to use this at all,
Right.
as long as we keep Kenny from running the meetings.
I second that.
I've only got a few more years.
I don't know what you're talking about.
And I think one thing we had talked about last time was the amount of coverage, and which is I
Right.
think why we had asked for different quotes.
Yes, the FMIT underwriters did not want to quote different levels. I assume it has to do with the value of the plan. We received similar information from the other companies that we requested quotes from.
Any thoughts or discussions? And this is for a 3-year term again?
Yes, that's correct. Pedro, do you have any comments on the policy?
So I was just gonna mention that, you know, the policy seems to be in order. I'm glad that you know, that you guys are looking at it, and it was a good observation in terms of what the difference is, right? One has a deductible, the other doesn't. They both have, one of the things that I look for is the waiver of recourse, which is also there as well. And then, you know, I think the discussion last time was really something to the effect of, did we have enough coverage, right? Or should we have something more? And I think that just in terms of practically speaking, you know, we tried to get other quotes and they would not, you know, it sounds like nobody would quote us for a higher amount. And I think I would probably agree that it could just be based on the asset value and something where it just doesn't make sense to them. But you know, obviously we can't speak to that. But I think that it should help the board feel more comfortable with the amount of coverage that you have. And then that obviously coupled with the fact that, you know, I think the comment was just made where, you know, we've had the same company for a while and hopefully we'll never have to use it. That's exactly right. I think hopefully we will never have to use it. The majority of my plans never have to use it. And so I think the board can feel better about the amount of coverage it has and binding the policy. My last comment would be also that by binding the policy, although it's a 3-year term, right? We can cancel the policy obviously whenever we want. So really the 3 years is more for the price, for the premium amount that we're going to be paying, more so than the actual agreement. So we're not locked into anything. So if we want to shop it around next year, we can do it again. You know, obviously probably not from this company, but it doesn't prevent the board from signing on with another carrier. So those are really just my only comments and obviously if you have any questions of me, I'm happy to answer them.
You guys have any questions? Or?
Just to confirm your suspicions, we get a lot of quotes for a lot of boards that help them for this purpose, and it is based off assets. So pricing and coverage, they use asset base to come up with those. So, and if this makes you feel any better, the $1 million with an $8 million balance it puts you pretty much in line with most of the plans we work with. Pedro, I'm sure works with a lot, so I don't know if he wants to add that, but I would say that it puts you well in line and not lacking compared to your other years.
Okay. If no other discussion, I think my recommendation would be to continue with FMIT Travelers at the premium of $18.93.
Move to adopt.
Second.
Okay, any other further discussion or questions? All in favor?
Aye.
Any opposed? Okay. Thank you. Next item is approved payment for the FPPTA dues.
Madam Chair, the FPPTA dues would need to be renewed. We've included the renewal online renewal worksheet. So if the board approves, we will process the payment.
I'll go ahead and make a motion to approve renewal.
A second.
Any discussion, questions? All in favor? Say
Aye.
Any opposed? So approved. Next is selecting an audit engagement option for fiscal year 9/30/21.
Hey, Madam Chair, looking forward to the end of the fiscal year, which will be upon us in the next about 3 months. We have reached out to the audit firm and requested updated or new engagement letters for the 9/30/2021 audit. Historically, we have prepared a standalone audit report every other year. For 9/30/20, we did an integrated report. That means it was integrated into the city's annual audit and issued financial statements. The auditor came to the last meeting and he did a presentation. He provided copies of the backup documentation, several, probably 20 pages worth of documentation. So the information is still there. If the board wishes to go with a standalone report, it's more expensive for the plan, but it will be a bound separate financial report. So the cost for the integrated report is $4,600, and then the standalone report would be $6,650. And that is a slight increase from the previous year.
Yeah, I know,
So I guess the decision would be whether to go with the integrated report or the standalone.
I would recommend we just continue with what we've done in the past, which would be the standalone report this year.
I'd like to make a motion to stick with the standalone.
I'll go ahead and second the motion.
Any discussion or questions?
Yeah, I mean, I don't know that we get the bang for the buck. But it is a policy that we've been running for quite some time. Mike and I watch pennies. And I don't know that extra kicker is that extensive for us, but I also agree, we've been doing it for quite some time.
Hey, Jared, do you have any input on that? Any additional?
I know in the past he's recommended.
So yeah, I mean, I think the important thing is, and one of the requirements of our plan and state law is that we have an audit performed. And so that can be certainly part of the city's CAFR, or obviously it could be a standalone. I think I may be the cause of the policy where we were doing it every other year, but I do see some value in having a report just unique or a standalone report rather than as a part of the city's annual CAFR report. And really, it's two reasons. One, primarily because obviously, and I think we touched on it briefly, the materiality component, right, is significantly different when you're talking about the city, which I think you mentioned maybe has a $36 million budget or something to that effect. And obviously our pension fund, right? That scale is going to be different. So in theory, you're getting a more detailed analysis of our financial statements with different testing parameters as part of the audit. Now, I'm not expecting anything to be found that's going to be different. I'm not expecting it to be anything significantly better, right, for the plan as part of our records. But I do think that it's worthwhile. Now, if we're talking about doing it every other year as opposed to maybe every 2 years, that can certainly be something, and we save some money on that front. But I just for my 2 cents, the extra, and I'm probably not doing the math correctly because I'm an attorney, but the extra $1,500 for the standalone, when you take into kind of just in proportion to the assets of our plan and the administration costs of our plan, it's a fairly marginal number, right? It's a fairly marginal savings. So, I think for whatever it's worth, I do think that there is value in it. Now, depending on how the board wants to do it, I don't have a problem doing it every other year, every 2 years. I don't see that as a problem at all.
Well, Pedro, this is the other year.
Right. No, I know, but I guess maybe if the board wants to, extend it so that it's not every other year, rather every 2 years, right? So every third year we would do a standalone, something to that effect. If the board, feels comfortable getting the included as part of the city's report, as part of the city's financial audit, and it wants to, add a little bit of savings, it could change the policy, I guess, to every 2 years. It would do a standalone, or if it just wants to scrap the standalone altogether, that's also a possibility. Although I think, what I'm trying to say is I do find value in the standalone. So I would think that at least periodically we should have a standalone report. Now, what that periodic timetable looks like, I think the board has some good discretion there.
Cindy, do you remember what the standalone cost was last time we did it?
I can look it up.
I think it had to be like,
In my rationale is, we're still auditing. What do we have? 2 funds going out to beneficiaries right now? And the funds coming in, and then their numbers. It's not like, Cindy's pumping out 600 payables a month to employees and suppliers and all. And that's where, if we had 100 beneficiaries out there that we were pumping money out, we need to make sure that every penny's going where it's supposed to, and that's the way I'm looking at it. But I'll support whichever way you guys want to go.
any other thoughts?
Well, we do have a motion out there, so you either have to amend the motion or accept the motion.
Right, that's why I was gonna get your guys, you have any other thoughts on moving forward with as we are, or amending it?
So we just move forward.
The last year's standalone report would have been $6,500.
Oh, so it wasn't that much different.
Just slight increase.
Any other discussion? Okay, motion to approve the standalone report. All in favor?
Aye.
Any opposed? And I see your point. But whenever he chooses to draw, yeah. All right, so something we had tabled from last time was the trustee removal policy.
Hey, Madam,
Review, yeah.
Madam Chair, last meeting, the board approved the same trustee attendance policy. So as a companion policy to the attendance policy, we have to have a trustee removal policy. Again, that policy requires a periodic review every 2 years. So now it's time to review it. We attempted to do this at the last meeting, however, we had some technical difficulties. So the board elected to table the policy until this meeting.
And I think that was just to get some input from Pedro on whether there needed to be any updates or changes.
Yeah, there's nothing needs to be updated or changed. I think unless you guys, want to change the parameters or want to change some of the terms, but it's pretty straightforward, and I think similar to the fiduciary policy. I don't think hopefully it's something we never have to use anyway. So
I'll go ahead and make a motion to approve.
Second.
Any discussion? All in favor, say aye.
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 Aye. Any opposed? Thank you. Okay. Oh, I lost my agenda. Keep the agenda.
You're on
Sorry, I
item
lost my agenda.
14 for Kenny. Using
To
Kenny.
approve Kenny's
That's
absence.
Kenny's absence, I'm
Okay.
sorry.
Approving Kenny's absence. That was from last meeting?
Move to
Right, so
approve.
this would be an excused absence.
I'll second. Any discussion? All in favor?
Aye.
Aye. Any opposed? So approved.
And before you switch, I gotta go get my little man, like within minutes. What do you want me to do?
Or you can just say you need to leave and you can go. That's fine, because we would still have a quorum.
Okay. I'm sorry.
That's okay.
I'm driving daddy today.
We've all been there.
Pedro, I'm sorry I'm missing you. Thank you.
No problem. Have a good time. Have a good summer if I don't speak to you. Be safe, man.
Thank you, Brian.
Thank you. Which brings us to our next item, which is the attorney update.
Perfect. Now Brian's gonna miss all the important things that I'm gonna say. No, just kidding. Luckily, nothing really to report from a legal standpoint. I did just want to kind of close the loop with respect to the legislative session, so that there were no bills or amendments that were passed that would affect our plan, or rather any municipal plan in Florida. And similarly, I did want to, however, update you as part of the budgetary process. However, there was an earmark for about $208 million.
Pedro, you still there?
It's
You were
been
breaking up.
assigned to the Department of Economic Opportunity. And these funds are going to be used to all quote unquote essential. I'm here. Hello?
I'm
you
sorry,
hear
can
us?
you start over? You were breaking up.
No, yeah, it's okay. Can you guys hear me okay now?
Yeah.
Okay. So I don't know where I lost you, but no changes on the legislative front, no bills or amendments that were passed. However, there was an earmark in the budget that was approved to allocate about $208 million to the Department of Economic Opportunity. And those funds are going to be used to pay quote unquote essential first responders, so firefighters, police officers, EMTs, paramedics, a $1,000 bonus check for all of their service during the last year plus during the quarantine and the COVID pandemic. We don't know exactly yet how those monies are going to be distributed. The DEO, the Department of Economic Opportunity, is supposed to come out with rules by the end of this fiscal year, so by 9/30, as to the who, the what, the when, the where, the how. But obviously, we should probably know a little bit more details in the next couple of months, so we'll keep you posted. But that is, obviously some good news for our firefighter members. So it should be coming. We just don't know when or how yet. But that should be at some point in the fall. I would imagine those checks should be delivered. So certainly some good news. And then lastly, I did just want to take this opportunity to remind you that this is that time of the year again where we do have to complete those Form 1s. Which is what I mentioned to our newest trustee earlier at the beginning of the meeting. And so those are due by July 1. So I did want to put that on your radar. Have you guys just maybe set a tickler for yourself, or if you can take care of it now, that'd be even better. But just to get it in by that July 1 date, and just recall that it is to be filed with the supervisor of elections in the county where you reside, which may not be necessarily where you're working. And really that's it. Educational opportunities. Next week is the FPPTA annual conference over at Champions Gate in Orlando. So if anybody's going to be going to that, I think it'll be a good respite from the virtual seminars you've probably been used to at this point. And if not, the trustee school, the FPPTA trustee school, will be in October. I want to say it's the second week of October. So there's another opportunity coming up in the fall if anybody's interested in that one.
Hey, Joe,
And that's it. That really concludes my report.
Pedro, will that be a virtual training, the trustee school?
No, so my understanding is that it's going to be live and in person, just similar to the annual conference coming up next week. It's going to be live and in person. They may or may not have a virtual component as well. I think I've gotten kind of conflicting reports on that, so I'm not exactly certain, but I think that they're trying to at least have a virtual attendance as well, a virtual platform as well for those trustees who maybe can't make it or maybe don't feel comfortable attending live yet, whatever the case may be.
Okay.
And the state hasn't proposed another school yet?
No. The state, my understanding is, although it has not formally canceled the school that's going to come up in the fall, that one's usually in the Orlando area as well. I do believe that, at least just kind of from my conversations with the DOR, I do believe that's going to be postponed as well or canceled as well. At least for the time being, I don't think that they're going to have it in person, but that could change, obviously.
Okay. Thank you.
Sure.
If there's nothing else, just need a motion to adjourn.
Make a motion and adjourn.
I'll second. All in favor?
Aye.
Aye. Any opposed? And next meeting, September 22. All right, thank you.
Okay, everybody. Thank you so much. Appreciate you guys entertaining me. I'll see you guys soon.
Thanks,
Thank you.
Pedro.
All right, everybody. Stay safe. Take care.
You too.
So that next meeting's changed from the 15th to the 22nd?
Yeah, the 22nd on the calendar.
Because I had it on my phone on the 15th.
Right,
But
and